This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company.
Now that the lawyers are happy, let's go ahead and talk a little bit about today's guest speaker. Dr. Keppler is somebody that I've been acquainted with for several months now. He likes to talk about what he calls auction theory, and he's been trading for a very, very long time. A very good educator. He's originally from Utah and is now in California. Used to teach at the University of Utah. I'm going to basically turn the time over to him. I'm very excited to see what he has to say to us today.
All right. Well, once again, I would like to welcome everyone that has joined us today. And I won't say good evening or good afternoon because understanding the nature of the international market that we live in nowadays, I'm sure that it is morning, afternoon, and evening for a variety of different people. So just a general welcome to everyone. All right, now I hope that my slide is broadcasting, and just like Jeffrey did, I too have to take a couple of moments to make our legal team happy. This webinar is designed and intended strictly for educational purposes only. It does not recommend, advocate, or urge the buying, selling, or holding of any financial instruments. The presenter does not assume any responsibility whatsoever for the actions of any person viewing or reading the contents of this webinar. The presenter may or may not hold positions in the financial instruments discussed. Trading and investing involve high levels of risk. Future results can be dramatically different from the opinions expressed in this webinar. Past performance does not guarantee future performance. This presentation is provided for informational purposes and educational purposes only and does not constitute any type of investment advice. Strategic trading does not guarantee the accuracy of information or warrant any representations made in this presentation and shall not be held liable for any inaccurate or incomplete information or for any improper or incorrect use of the information contained in this webinar. All right, now let's delve into our topic. We are going to talk about probably one of the most significant topics when it comes to trading, and that is strategy. As a matter of fact, I will venture out on a limb here and tell you that your strategy when it comes to trading is actually going to always determine your success or failure as a trader. That's how important strategy is. On our agenda, we're going to talk a little bit about this importance and why it makes such a difference to a trader having the appropriate and using the right strategies. We are then going to navigate into looking at what it actually takes. What are the elements? What are the ingredients that make a strategy profitable? Certainly, we can have many different types of strategies, but the key is to have a consistently profitable strategy. That's really what distinguishes a successful trader from someone that is consistently losing money. Last but not least, I always like to present some examples of the concepts that I teach to actually show you how the things that we talk about actually manifest themselves in the real market. So that will be the last and concluding part of our presentation. All right, let's begin by talking about the importance of strategy. Now, I would hope that everyone in the room understands that anytime you are going to embark on any kind of a meaningful undertaking, having a strategy is very, very important. Now, why in particular is it especially important for trading? Well, strategy will determine whether or not you will make money and whether or not you will succeed as a trader. And consequently, your entire trading career is going to hinge on your strategy. How, first of all, you begin to develop that career, and two, how you implement and apply the methods that you use when it comes to trading the market. Now, you will hear other people approach it in a slightly different manner, and some of them may tell you, you have to have a plan. You have to have a plan. Absolutely. The plan is certainly a very important part of the strategy. However, your plan itself must also include actual trading strategies. So I view the plan as a broader concept of strategy. Your plan looks at basically what you're going to trade and in general terms, what approach you will use, what strategies you will adopt. So it is more of a macro picture. The actual strategy that I want to focus on in our discussion today is how we approach the market and how we in fact execute trades in the market. Well, the reason behind the importance of the strategy is it forces us, first of all, to think ahead before we enter the market. So thinking ahead is very important for a trader. You never want to get into the market, start a position without having thought in advance why you're doing this and what you expect to get out of it. So it does provide a plan and organization for every single trade. It also helps us as traders to keep our emotions in check. If you do not have a strategy and you just enter the market at whim, your emotions will play with you. And quite often, they won't allow you to let a winner run, or they won't allow you to actually exit when you have a loser on your hands. Emotions are a very important part of trading, and one of the best ways to control emotions and learn to develop a sense of discipline when it comes to trading is by, in fact, having a strategy. In addition, the strategy helps us to limit our risk exposure in the market. I predetermine the level of loss that I'm willing to accept on a trade and the exposure that I will take in any trade. That becomes part of my strategy. Last but not least, it also gives me a yardstick or a benchmark to measure performance. If I don't have any kind of a strategy, how can I evaluate whether something is working or not working in the market? So I hope that I have convinced you that strategy really does make a difference when it comes to trading. Now, if you haven't been making money in the market with the strategies that you've been using, my recommendation to you is really to stop. There is no sense to keep losing good money after good money and just continue on a path of losses. If you are not making the kind of money you want in the market, it is definitely time for you to look for a new strategy. I frequently find that traders will fall into what I call the insanity trap. What they do is they keep doing the same things over and over and over again and expecting to get different results. And quite often, they don't even realize how obvious that this is really crazy. You can't keep doing the same exact things over and over again and expect different results. It just is not going to happen. Something has got to change. Your approach needs to be revised and revisited. Now, the other trap that I often find traders fall into, they keep looking for the single one winning strategy in the market, or that holy grail, that technique that once you discover it, the secrets of the market will unfold and the fountains of wealth will appear and you'll be able to wash away all those horrible losses and life will change forever. Unfortunately, that is a mirage that many people spend and waste a lot of money changing. The secret of success really lies in the trader themselves and the kind of strategy that they use in the market, not in a secret technique or some sort of mysterious piece of knowledge that somebody out there knows that they're keeping a secret from everyone else. Believe it or not, all traders at some point lose money on their trades. I have probably been doing this for a little bit over 20 years, and I have yet to meet a successful trader that told me they never lost any money. It just is not possible. As a matter of fact, most successful traders are proud of the fact that at some point they were losers and they managed to turn that around. And that's what made them successful, because they learned how to avoid the mistakes. They learned from their mistakes and they were able to develop more successful strategies. But there is no trader out there that has the Holy Grail and does not lose money. It's just a natural part of the process. Key is you want to be a consistently winning trader, not a consistently losing trader. And so now, how do you develop a strategy that is profitable? That's the next part of our discussion. What are the elements? What are the ingredients? What really has to be a part of that strategy for it to work and to become consistently profitable? Well, the first and the key element that I always like to identify for all traders is the fact that your strategy must be in alignment with the market conditions. Quite often you will find that someone has some signal or some system, and all of a sudden they follow it and they find that at times it wins and at other times it causes them a lot of grief and they're losing money with it. And the reason is they're not understanding what the signal is based on, and they're not aligning the signal with the right market condition. For a trader to become successful, they must learn, first of all, to be able to read the market condition, and then two, to choose and apply the appropriate strategy for that condition. Strategy is not a one-size-fits-all. There isn't one strategy that will work in every type of condition in the market. As a matter of fact, there are many different types of strategies for different types of conditions in the market. So the alignment is very, very important and very crucial. And I will show you in the example that we look at today how we identify the market condition and how we align the strategy to that market condition. Now, quite often traders will say, well, they're really just two basic, simple, easy market conditions. The markets are either trending or non-trending. Well, while that is really true in theory and conceptually, in practice it is far more complex than that. If we take a look at the anatomy of a trend and we begin to identify a trend, we will find that once we've identified it after the fact, it is very easy and it looks very obvious. I mean, who could miss it? Prices here are all above the 20 moving average and they're rising higher, and I have higher lows as we go up and higher highs, the classic definition of an uptrend. And here on the right hand side of my chart, it couldn't be easier. Lower highs as prices move lower and lower lows. It is another downtrend and all prices are below the 20 average. But the key is when it's actually happening in the market, it really is not all that obvious. And that's where the talent and the art and skill comes into play in being able to identify the market condition and to be able to identify a trend very early in its development. Not after it's been going on for a couple of hours and it's obvious and the trend is now ending, so now I've been able to identify it because all of the theories apply to it. That isn't what I mean by being able to identify the market condition. Now, notice here, for instance, when I have a trend line, that adds a little bit more information and it allows me to participate in the trend, at least on a retracement. But I have to know what a retracement is to be able to participate in on it. Retracement is when the trend comes back and finds support at a particular trend line. Now, the trend line can also take several forms. It could in fact be a moving average. It could in fact be a trend line that I draw myself on the chart. So even to be able to get a trend retracement, I have to be able to identify the level of retracement and where the market might retrace to. Now, quite often traders will make mistakes and they will think that there is a retracement when all of a sudden it really is a reversal. Take a look here what happens. The market has been moving lower, so it retraced up to this point and then all of a sudden it went lower again and then it retraced to this point, and then what is to make me think no, it's going to go higher, and it doesn't really come back and head even lower. It is not that obvious when the market is happening. It's after the fact that it always seems obvious. Now, I can tell you why very quickly. It is starting to head higher and not heading lower. And one thing that I will tell you right away, take a look at, first of all, the level of the retracement. Here, look at the retracement, the size of it, relative to the size of the retracement here. This alone would be adequate to give me pause. Now, perhaps prices would be turning at this point because this is an inflection point. It's the point of support back here, and they could turn and head lower. So rather than make the assumption that that's what's going to happen, I need to be able to identify these inflection points. And then I scrutinize what is happening in the market at that point. But being able to identify the points that are worthy of my close scrutiny and inspection in itself is a critical part of the strategy and requires some market knowledge and some understanding of how to read charts and how to follow the patterns of price movement in the market. Now, another simple pattern that I'm sure everyone is acquainted with is a sideway market or a market that's consolidating. And those are easy to spot because you will always find that prices will be contained within a range, a support and resistance level. And the key question that we often have to confront or ask or answer when we are looking at a consolidation is which way is the market going to break? Will prices break to the upside or will they break to the downside? And the key again is to use a strategy that helps us anticipate what is going to happen and be a step ahead rather than being able to just analyze after the change or after the condition has occurred. Now, notice, even with breakouts and breakdowns, they're not always as clear and as clean as you might think. Very often, I may have a breakout of consolidation only to find prices turning right back around and selling back to this resistance level that existed before, in fact, they begin to move higher. Now, being acquainted with this pattern gives me a strategy that if this in fact occurs in the market, I am going to be a buyer here, and I'm also going to be a buyer here as the market continues higher. Most other traders that are novices and are not familiar with this pattern may in fact get very discouraged if they bought on this breakout, they find it dropping again and they put their stop loss there, they're kicked out of the trade, and that ends the trade for them, simply because they don't understand the condition of the market. Now, you need to also be aware that anytime you enter a trade in the market, you are competing with probably some of the most sophisticated computer algorithms and some of the brightest minds on the planet. One cannot do that without a strategy. One can't be successful in a market like that without some basic knowledge. And that's why the strategy is your protection. And it's very important for you to develop strategies that you've practiced and that you know like the back of your hand before you think about ever putting a trade. Now, another element of a successful strategy is your strategy requires a confluence of market activity. The market is not just about price and tracking price movement in the market. There are a number of different moving elements to the market, and I want to be looking at all of them simultaneously. I don't want to have a one-track mind. If prices are going up, that really is not the full story. I need to have a perspective on time and what's happening in different time frames. I also need to be looking at volume dynamics and the momentum that the market is experiencing. And I have to be able to integrate these key market elements as part of my strategy. I can't be a single indicator or a single perspective trader. I need to be able to integrate the key elements in the market and be able to develop a confluence of evidence before I decide to put my hard-earned money into the market. Now, another very important element of any profitable trading strategy is the profit target. I am amazed at how many traders actually place a trade into the market and they don't have um, they don't have any kind of idea about where the target is for the trade. And so as soon as the trade becomes profitable, if you are trading a stock and it's a matter of getting 5 cents or 10 cents here, they're delighted and they're happy and they grab it and they run. That isn't the way to trade. You must think ahead about what's going to happen, and you must have a projection for where your profit target is for the trade. Now, you may not always realize the target, but that's another element that we're going to talk about, which is the emergency exit. If things didn't work your way, what are you going to do? And we will talk about that element next. The emergency exit is what a lot of people will call a stop loss. Now, I like to call it the emergency exit because that's how I think of it. When I go into a trade or when I develop a trading strategy, I rarely rely simply on my stop loss to take me out of a bad trade. I need to be aware when things are not moving my way much earlier than the stop loss. To succeed in the marketplace, it is very difficult to work with very tight stop losses. Nowadays, the computer algorithms almost knock those stop loss points without hesitation, and they just nab them like you wouldn't believe. So I use the stop loss as more of a worst case scenario. If the market really something dramatic happens that I don't have enough time to be able to react to the change in the market, my stop loss will save me. So I still select an appropriate level for it, but it is not usually as tight as most people put them. Traders that use very tight stop losses are going to find, unless they're using incredibly fast technology or that usually is not available for individual traders, they will not be able to function with very tight stop losses. So your strategy has to function properly in the market to allow you some breathing room for the trade and not to let the market take you out prematurely. Next item that I always like to talk about is the risk to reward ratio. I often find that people will quickly pick up on the fact that they can't have a tight stop loss. So what they do is they widen the stop loss and then they get into a trade. And the minute the trade is positive, if they're in a forex trade and they get 4 or 5 pips, they dash out of the market while they were risking maybe 50 or 60 pips to keep the stop away. That just does not make sense. You should not be trading like a mouse that's afraid of a trap. You need to be trading with confidence. And the more you study and analyze how you structure a trade and a trading strategy, the more you will gain that level of confidence. And you won't be trading sort of continually in fear of what might happen next. So you need to have a proper risk-reward ratio. You can't be risking $100 to simply make 10 cents. Just the risk to reward ratio just is not there. Now, a strategy must also be practiced and tested. I work with a number of different students and a number of different traders, and it is amazing how some strategies will work incredibly well in the hands of one trader, and yet the same exact strategy in the hands of someone else does not yield the same types of results. People are different, and consequently, whenever you hear anyone sort of boasting about numbers from a strategy and so on, that may very well be true for them. Anytime you have a strategy, you need to work with that strategy and see how it is working out for you, not so much how it worked out for someone else. So you must have time to practice, to test, and prove the strategy in your own hands, and before you ever commit a single penny of your hard-earned money in the live market. And that's the beauty of a strategy. You can actually test it. That's what paper trading is for. That's what simulators are for. They're not just to sit there and play on them and pretend like we've made lots of money today. That's not what they're for. The reason they're there is to help us become more efficient, more effective at what we do. And the only way we can do that is to use them efficiently to test strategies that we have. So you never sit and sort of randomly place trades and think that that's how you trade based on results that you get paper trading. If you're going to paper trade a strategy, a methodology, a way to make money, not just haphazard entries and exits. Last but not least, we cannot overlook our tools as part of a profitable, successful trading strategy. You definitely need the right tools for implementation of your strategy. Now, different strategies will require different tools, but the tool is a very important element. First of all, I need the right tools to be able to identify trading opportunities in the market. If my trading platform doesn't give me the right tools and the ability to identify these trading opportunities, I'm not going to be a successful trader. Now, there are other elements also that come with the execution of a trade, and for those, you also have to carefully evaluate your execution platform and how you place an order, the ease of placing an order, and how it allows you to interact with the market. All those are very important things that a trader must look at in building their strategy. All right, the time has now come really to demonstrate for you and share with you these concepts in action. And we will begin with a condition that occurs in the market most of the time. I didn't want to take something easy like just a trend. No, sideways markets. We tend to see those most frequently. As a matter of fact, statistics tell us that markets trade about 70% of the time sideways or in a consolidation pattern. So immediately by looking at this chart, I would hope that you are able to identify that that is the condition of the market. Now, how can we do that just by looking at the chart immediately? It actually is not that hard. First of all, you need to identify that there has been a range high. In terms of looking at the price movement that I see on the chart, if I sort of look at the pattern of the movement, there is a high level here that I have not managed to break out of. And if you notice, there's also a range low. So I have a range high and a range low. Anytime I see this pattern that prices are coming up to a certain point and then coming back down and then coming back up, you've identified a sideways market. Now, how am I going to develop a strategy and how am I going to effectively trade in this market? Well, let's enhance the visual a little bit. Let's start using some of the tools that are available to us. And I always like to keep things as simple as I can. I don't like to complicate things. So let me begin by adding just two simple moving averages. And that's exactly what they are. I use simple moving averages. For some strategies, I may use some of the more exotic ones, the Hull or an exponential and so on. But for our purposes here, we are looking at just two simple moving averages. The green is my 8 simple moving average, and the 20 is my, or the blue is my 20 simple moving average. I always use blue, the blue color for my 20 moving average, that I think of the moving average before I can even think of the color. And by the way, that's another very important tip in being able to recognize things on your charts. Consistency. Don't change colors of everything on different charts. Try to keep things consistent. You will get used to it, and you will begin to immediately sort of discern and detect things very quickly because of the consistency that you have on your charts. All right, so let's see now. I have a crossover down here, so it means that prices start really to turn around this point. I have some crossovers up here. They help me see this consolidation pattern. Now, there are some other telltale signs that I'm going to share with you now. Notice what's consecutively happening in the market. Here, we had a low, then we had a lower low that matched this low here, but now the market is showing me a higher low. The range low is moving higher. Already, this is a telltale sign that the likelihood that we're going to break upwards is much higher than, in fact, breaking lower. And it continues, and I'll give you more examples of how we continue to validate this. Take a look at the range high. It still stays where it's at, and here's our range low moving a little bit higher, and I'm going to add a simple trend line. Now take a look. As I extend this trend line out and prices drop, look at what happened. They got picked up again immediately. There was a buyer ready to buy right at this trend line. So now I have two telltale signs that many people may not quickly see that I'm going to get a breakout to the upside. My lows, first of all, my range is moving tighter and the low of the range is moving higher. I am also getting higher lows as we begin to develop. And if you want to look at a slightly broader picture, I also am developing a little bit of a triangle. So you see, it does take a little bit of effort to understand and analyze the condition of the market. And the market will tell you all kinds of interesting things if you are just willing to pay attention to them. Now, notice the higher highs, the higher lows, but actually no higher highs yet. And the low range moving higher, and a whole bunch of things before I get any kind of a breakout. So I prepare for the breakout. The minute that I begin to see prices trading above this range, I am ready to get into the trade. So the market conditions identified for me what I wanted to do well before it happened. Now, once it happens, if I've done this a dozen times and I've seen how it unfolds, I am ready to take that trade. I am now a confident trader and I have a strategy. I'm going to implement my breakout strategy, which really tells me buy as soon as the breakout occurs. The breakout occurs here, and let's sort of follow our theory of confluence and get a couple of more confirmations that we are in fact on the right track. I showed you the trend line, I showed you the higher lows, so we had a confirmation from a multitude of sources so far, the confluence that I was speaking about earlier. But here's an indicator that I often like to use, and it is a great indicator in general, and it is exceptionally well, it performs exceptionally well on the MetaStock platform. And this is just a standard MACD. I haven't done anything to it. and take a look at what it is telling us. In fact, the MACD is moving higher. Momentum is moving higher with the move. That should increase my level of confidence, and it gives me an added element to the confluence that I'm looking at. So now that we have responded appropriately to the market condition and we have the confluence, let's take a look at the target. Well, the best way to project for your target is to take a look at the last low here at the range that we had and project about the distance between the upper limit and the lower limit right here, and you will find that we have about a target of, I would say, $10 in this trade right here, from about, at it here, about somewhere 337 or 333, all the way up to, I usually estimate it so it doesn't have to be exact. There's about $10 in this trade. Now, where do we place our stop loss? I will place my stop loss at the low of the entry bar. And this is my entry bar, this bar right here when the breakout occurs. And this is where I would place my loss, my stop loss, at the low of that entry bar. If in fact things change in the market and prices start to roll back, something has gone wrong and things have really changed. And by the way, this doesn't mean my strategy is bad or that all the data that I have assembled is meaningless and I should throw it all away. That isn't true at all. What you need to be aware of, it's just the nature of the market. What if all of a sudden something happened somewhere in the world and all of a sudden the market is reacting to it and sellers have stepped in like crazy? Well, that could happen at any instant in the market. And that's why it is important to always have a stop loss, because of the unpredictability. No one with any level of certainty can predict the future. And if you can, then you shouldn't even be listening to this webinar. Give me a call and I have much better strategies for you if you are able to predict the future. So we have to be realistic about our expectations in the market, and we have to prepare ourselves for the worst case. So now I have my target, I have my stop loss, and I told you my target is approximately about $10 based on that prior range, and my stop loss, if I put it at the low of that bar, and I base it on an entry in the middle of the bar, and I would hope that you would enter much earlier than that, gives me a ratio of 1 to 10. Now, by the way, I didn't take a moment to identify for you the instrument that I'm trading. I thought that you could probably tell from the price, but let me share with you, we are actually looking at Apple computers, and we are looking at a fairly recent trading activity in Apple. I always like to give current examples of what's going on in the market. And we're looking at a half-hour chart. So now that you have all the elements of the chart together, take a look with me at what happened. We broke out, and again, I told you I placed my entry mid-bar, although I would have hoped you could get into that trade a little bit sooner, but I always like to take a reasonable scenario. Let's say you weren't fast enough and it took a little bit of time for you to get into the trade. So let's enter at about 34.80 and let's watch together how this trade develops. And here's my target. Okay, and I told you that there was about $10 in the move. So when I get to my target, this is another thing that is very important. You don't want to get greedy. If you have a target based on your projection and your analysis, stick to it. You could always start another position, but you should adhere to the elements of your strategy. So as soon as I arrive at my 359, which is approximately the $10 target that I had, then I am out of that trade. So if in fact your target was or you entered at 348 and we put our stop loss at 34764. It never even came near our stop loss, so we were okay. Now, some individuals like to only trade for the day, and if in fact you wanted to be out during that day, you could have been out at a high of 353 with about a $4.20 profit. However, if you wanted to allow the trade to go to its full fruition, it would have involved a couple of days, and that's what we would call a swing trade, and I would be out at my $10 target. Easily, I would get that $10 out of the trade. Now, when we backtest the strategy, you can also begin to alter and change the strategy based on the time frame that you wish to choose. You don't necessarily have to use it on a 30-minute time frame. You could use it on a longer or a shorter time frame. You get to create a record of the performance and evaluate the strategy performance on different time frames. And this is how you are able to build your experience and confidence level as a trader. You have to have some way of going back and evaluating your performance and your strategies and how well they worked out. Now, once again, proper tools. Hopefully you have a decent analytical tool in terms of the software that you use. You have the right execution tools, and the right tools will help facilitate the success for you. Those are very easy to put in place, but those are also key elements of being able to execute and implement any kind of a strategy. Now, let me take you back to our strategy. We accomplished the goal that we wanted. We arrived at our target. The key question that I want to put before you now is the move likely to continue higher? Everybody's been incredibly bullish on Apple, and it's just skyrockets, and that thing never seems to want to quit. So should I, now that I'm out of this position, and take a look now, moving averages are moving higher, everything still looks like we are in a trend. And I benefited from this trend. I managed to get into it all the way at the breakout, and I'm out with my 10 bucks. As you know, I only trade one share, so I bought one share and I'm out. So I got 10 bucks out of the trade. Now, is the move likely to continue? Maybe I can get another buck or two. Well, take a look with me, and I would be curious how many of you in the room tell me that yes, Apple is one of the most bullish stocks. Let's get in on this action once more. Go ahead, take a stab at it. How many would say yes, buy Apple again at this juncture? Go ahead, don't be bashful. You only have one of two answers, yes or no. All right, all right. I have a whole bunch of yeses, some no's. Right, no, okay, yes and a no. Good. The key that I want, okay, I love the honest answers of I don't know. And that's really how you are going to learn. You need to look at different market conditions and begin to sort of ask, what is the market telling me? And what can I detect from the market? You know that Apple has been bullish and so on, but I want to highlight for you something that is often overlooked, that many people don't look at. And this is where the ability to look at a couple of different things helps us. Take a look at the divergence that we have here. The MACD, once again, look at the momentum. The momentum keeps riding lower and heading lower, whereas prices continue to go higher. Anytime you see this divergence in the market, keep your money in your pocket, as far as a long at least. Don't go after that extra dollar. And notice how it just sort of seemed to get to our target comfortably, and now it's ready for a change. And I can actually see that it's ready for the change before the change happens, because I'm not just looking at price. After all, if I were just looking at price, look at this beautiful big red candle. And you will find there will be many there that will tell you, and you'll have big volume with a big red candle. It's going to go to the moon. Well, no. I learn to look at all the signals that the market is giving me, not just price, and not just one big green candle. And let me show you what actually happened. Take a look. This is what happened after that big green candle. We got into a little bit of a consolidation pattern, and guess what? When I saw the consolidation, I was ready for the breakdown, and I took the short at this point. Price drops. That's what a trader with strategy does. First, they learn to understand the market. They have a system, a framework that they work within, and they know what to look for. And then they follow their strategy and they adhere to it. That's how you become successful as a trader. It really is not that hard. It just takes a little bit of practice and a little bit of awareness in terms of what to look for in the market. Now, if we are going to look at trading a trend, I will show you also some very interesting and very nice telltale signs. Here we happen to have a downtrend, and you will often find that in a downtrend they're easy to spot after the fact. But again, let's look at the consolidation that happened here. And then we had something happen which is an incredible telltale sign. Take a look at what happened with this red candle. It went up, and then I see a wick. It started to drop after hitting where the 20 and the 50, and I should now tell you the red line that I have here is my 50 simple moving average, where it actually hit those two together. That is, whenever you see that, you've hit the gold mine. Take that short. That is a very comfortable short. Prices are going to drop. The 20 crossing down below the 50, and at the same time prices came up to test it and failed. Not only that, let's go for the confluence. Take a look at my MACD. My MACD is already heading lower and is below the zero line even as this test occurs. So I have the confidence and the confluence that I need for my breakdown that I'm waiting here at the consolidation, ready with my strategy. I got signals that I want. There's the short entry that I've been speaking to you about. And the moving averages continue to head lower. Now, the key point here is, where would my target be? This is where my target would be, this last support level. Yes, I know the price is headed lower. One thing that as a trader you must learn, do not ever expect that you are going to get the peaks of every move and also exit at the bottom of every move. I don't care how great a trader, if anybody is telling you they are consistently doing that, I would love to meet them. I mean, I've worked with some of the best traders, and none of them can time the market with that kind of precision. So I know that you have to be reasonable. As long as you can capture about 2/3 of the move, you are doing great. And that's another thing, having reasonable expectations and a proper way to evaluate and measure your strategies. And this would have been a beautiful trade right here all the way down to the support line. You would have still made about a little bit over $10 again on the way down. All right, and the target here again was that previous support level that we had. Now, in case you missed it and you wanted a retracement, you could have also entered into the short again when the market retraces and fails to break the 8 moving average and then continues lower. So there are abundant opportunities every day. The key is just being able to identify them and to understand the market condition. Now, let's take a look at what happens when we're looking at a reversal. We've broken the support level, and now everybody gets very bearish and they think, oh no, it's going to keep going down forever. But take a look at what happens. We develop an interesting pattern. Prices, first of all, find support here. And then once again, we find support here. And once again, there's support here, but it is a little bit higher. But what happens, we come back to test this level of support. So what do I do now as a strategic trader? I begin to draw the pattern that I see. And I will also learn from my experience in tracking and following the market that anytime I begin to see this W pattern, that this is a reversal pattern. just takes patience. And as you can see, none of this is rocket science. It really is very intuitive and very simple steps that you just have to begin to track. When we get to a new support level, how is price behaving? Okay, it came once, it bounced up. Well, what did it do again? Well, it came back down. It was a little bit higher, then came back up, and then it came back down again. All right, I know I'm in a consolidation pattern. Well, let me draw what's happening here with a line. And so I am ready again at the breakout. There's my top level here. And as soon as I break out from this new high that I had, new high for the newer range, I am ready to come in and participate in the move once again. Now, sometimes the move is a very strong move and the profits come in quickly. Other times, the move takes a little bit of time to build. If you notice, the move did materialize, and notice also that the range here, the target, is pretty much equal to the range that I had here. So my method of predicting or projecting the target ranges works fairly accurately. And then what happened after that, things started to change once again. All right, well, I hope I've had an opportunity to share with you a few different perspectives into the market and market conditions and how we approach trading it strategically. And Jeffrey told me that I wouldn't get to do this webinar unless I made some kind of a special offer to the participants. So I have acquiesced and I have agreed to offer a $100 gift certificate. And by the way, this is the very first time that I've ever done that for this 6 simple trading strategies instructional video. And the reason is I've priced it intentionally very low just to give people an opportunity to earn some money with strategies. I mean, one trade could easily more than pay for the regular cost of this set of videos. But nevertheless, Jeffrey, you will owe me one. And I would be delighted to offer you these 6 simple trading strategies on these videos at this special price today. Now, as usual, I always will entertain any questions and answers that you may have. And since I see that we are quickly running out of time, I will also extend an invitation to you. If you have any specific questions that I do not have an opportunity to answer, please feel free to email me, and I would be more than happy to answer you. The thing that I always tell people is just allow me a little bit of time to get back to you. Sometimes my emails are just overwhelming. All right, let me take a look and see what questions we have here. Where can we retrieve a recording of this session? I love those nice, easy questions because Jeffrey will answer them. Jeffrey, how can they get a recording of this session?
Oh, that's easy. Simply need to wait, and right, tomorrow so we'll send you a copy of the archive.
Copy of it from Jeffrey. What would you have done with today's market move? Oh boy, you want another whole webinar in 5 minutes. As you can see, my method is very systematic, and really it takes being able to plan ahead and look at things a couple of steps in advance. So you know, and it's very, very thorough, and it just wouldn't be right to tell you what I would do with a whole market move in a minute or 2. So I may develop another presentation especially for you in the next webinar. All right, let's see any other questions here. All right, well, good. Once again, if you do think of any questions, okay, they're starting to stream in. Did your strategy help during the flash crash last year? Absolutely, and I'll tell you what really helped. The fact that I did have a stop loss, because if I didn't have a stop loss, I would have really been hurt in my position. And unfortunately, yes, it did take me out of the market. And I always trade knowing that there's a possibility that my stop may get taken out. So I never risk more. I have certain parameters of what I can risk and what I cannot risk. So absolutely, my strategies help me in every market. I would not survive without them. What other indicators do you use? Okay, well, Dan, I use a multitude of different indicators, and there are some indicators also that will soon be featured in the MetaStock package that I have, the proprietary indicators that I have developed. They're not out yet, but they are coming. In terms of the standard indicators that I do like, again, I love to keep things simple. The simple moving averages are very important. Use trend lines. Trend lines are worth their weight in gold. I also like the MACD, and I also like the directional DMI, the DI plus and the DI minus, and the ADX. Those are some of the basic ones that you'll find on all platforms. And in developing the strategies that I have put in that package, I try to keep it very basic, very simple, and to use indicators that people will find everywhere. I didn't want to use anything that is terribly exotic. And for those of you who like exotic, I've got some exotic things too. Is the risk-reward ratio the same as the stock beta? No, Isaac, it is not. They're two very different things. Beta is a measure of stock volatility. Risk-reward ratio is the ratio of how much am I willing to lose relative to how much I have the potential to gain in a trade. How do you feel about the covered call strategy? Well, if you do it right, I feel very good about it. When you use options, you have to know what you're doing. And ultimately, at the core of any trade is how well you understand the market, and is it the appropriate strategy for the market condition or not. How do you select the trading vehicle, stock? Jesse, that's a good question. I have traded a multitude of different instruments, ranging from commodities to forex to stocks, and ETFs and futures. Um, I just love trading, and quite sometimes for me, getting a new instrument to trade is very exciting, because now I have to learn some things different, and I have really to put my skills to the test. However, what I like to recommend for people is, if you're going to get into trading, start with something that is simple, and don't overextend yourself. Don't try to be a forex trader one day, a commodities trader the next, and an equities trader, a stock trader the third. No. And even if you're going to be an equities trader, and if you want to trade stocks, pick perhaps half a dozen first to follow, or maybe even just 3. The more you build up your skills, the more the window of opportunities will avail itself to you. Uh, Making money in trading is not about trading many different things. It's really about learning many different strategies to trade, and then applying them to each thing that we trade. So you have to be selective, and some of that has to do, for instance, if someone only has time to trade in the evening, they may be more inclined to trade forex, because it's a 24-hour market. So choosing the instrument is a very individual decision. You have a specific strategy to calculate the exit price, or is based on the risk-reward ratio. I have specific strategies to nail down where my exit price is, based on the type of trade and the time frame that we are using. Once again, people like to find or determine a rule of thumb or an easy answer. What you're going to find is, as a successful trader, you have to be flexible, and it will never work as one size fits all. You have to accommodate different instruments or behave differently, and different types of trade setups also behave differently. Some of them I can be very tight with my stop. Others I have to allow a little bit more breathing room, because of the nature of the instrument and the auction market that takes place in that instrument. I agree with your comment about options too. Do you yourself use option strategies? How could a trader ever be complete without options? Absolutely. I do use options, yes. All right. With that, I am going to conclude my presentation. And once again, I thank everyone for joining us today, and I wish all of you the best of success with your trading.